Hello everyone, in today's video we will be going over the 10 chart patterns every futures trader should know. If you want to succeed as a day trader, I think it's imperative you must know your chart patterns inside and out. Not all chart patterns are going to have the same success rate, so it helps to know the most common chart patterns and how to trade around it, meaning knowing how to manage a trade or take alternative entries if a pattern fails. Before we go through these chart patterns, I just want to point out the obvious, and that is it's really easy for anybody to go back through a chart and mark these up and identify, a double top or a bearish flag. The difficult part is trading it in real time, anticipating what potentially might occur coming up to a certain level or a certain channel, and executing a trade in real time. So while we go through these chart patterns, I'm going to also bring up some tools within Optimus flow that have helped me identify specifically within order flow whether or not these levels will hold, or if it is a fake breakout, or are sellers coming into the market on a double top and really aggressively pushing the market down, or does it look like it's going to go up and continue to break out? So we'll be going over some of those more fine-tuned details within Optimus Flow as we go through each chart pattern. The first pattern we'll look at is a double top and fake breakouts. A double top is a bearish pattern that can occur frequently in the markets across different time frames. The big question that we have with a double top is how deep a market can fall upon failing to break out of the peak. So here on 6/15, we made a high at 94. And market traded down from that, came back up to test it on the 29th, spent a day up here, and then fell back down. The one thing that I like to do when choosing a target, if I took a short trade at this area, is a Fibonacci retracement. So I would take the Fibonacci retracement from the first up day in this move all the way to the top. Right about there. And personally, again, this depends on your trading style, how long you're holding trades. I like to look for a 50 or 61.8% retracement. So the thing that we have here is when we zoom in on this day on the 29th to really determine, okay, is this double top going to hold? The one thing that I always like to look at is the footprint chart. So the first time it came up to test it was here, and we can see here this is a 5-minute footprint chart. Came up again to test it, and it did spend some time above this level, but what I would be looking at is more in real time how these orders were coming into the market. If there's a lot of absorption up here in this area, indicating that sellers are eager to take these prices as it peaks above that level. And we can see that it only spent from 10:30 Pacific time right up until the close, so only a few hours, and then it drastically fell away from that area. So typically, if a double top is going to fail and price is going to break through it, you would see a lot more aggressive buyers up here and less eager sellers. And again, I always pull this up on the footprint chart. It's extremely easy to see with an Optimus flow. We have videos on how to set up footprint charts, but this is a tool that has been very helpful in identifying how orders are coming into the market and overall market sentiment. The other tool that we can use in Optimus flow to determine risk reward is the price target tool over here on the left. We would just click on that and click on wherever we entered the market or wanted to enter the market, drag it over there. The one thing that you will need to do is right click on this and make it set to whatever trade you're taking. So in this case, it would be a short, and your take profit would be on the bottom, stop loss on the top, and it will give you a reward to risk ratio. Again, I would be using this in conjunction with the Fibonacci tool in this particular case. Again, if my price target was a 50% retracement, I'd be looking for roughly an exit around 44.36. So I would just drag my take profit to around that area and make sure that my reward to risk ratio is in line with whatever my trading parameters are. The second pattern we have is a head and shoulders. Similar to the double top, a head and shoulders pattern is another popular pattern that traditionally signals a bearish reversal. The pattern will show 3 attempts to break toward the upside, which have failed, and the middle attempt, which is the head, having the strongest momentum. Here we have a daily chart of the S&P Mini. This isn't a super clean example of a head and shoulders, but it has a lot of the characteristics of one. We can see price here climbing above to make a new high, coming down to the 43.72 level, which is going to form the neckline, making another push up. Here we have the head. Price has come down to the 43.72 level again, and we see price coming up here, which is forming the right shoulder, and now price is coming back down to form the neckline. So the head and shoulders pattern can obviously form on any time frame, but what we want to see when we potentially trade this pattern is a violation or a strong violation of this neckline. And what's happening here is that people who have bought here and also bought here, the idea is that they will have their stops below this neckline area. And if price continues to fall down, all the buyers who purchased here are eventually going to puke their position, which is going to fuel the downward price movement, which would eventually validate this head and shoulders. The next pattern we have is a V top and a V bottom. These are quite straightforward, but they can also be very easy to miss. If you're looking to trade the top or a bottom of a market, double tops and bottoms are typically easier as they provide more info. For instance, a failure to make a new high or a low within a double top or bottom, and also 2 chances for entry. Not so much with V-tops and bottoms. In a case like this, it helps to understand the fundamentals behind a market to better assess whether a market is going to break down or recover. Pennants are essentially small symmetrical triangles. They can approach the trend from almost any direction and often occur after long trending periods when price pauses and traders reposition themselves. Most traders make the common mistake of jumping on premature signals, which is called FOMO. Instead, we want to wait for the actual confirmation that price is breaking out of such a pattern. Usually the breakout signal happens with a violent and strong candle indicating that the trend is ready to resume. So here on the 5-minute, we can see that price has come up and is starting to trend down, at which point price starts consolidating in this pennant pattern. And what's happening here is that as the pennant continues, price is contracting, and eventually we know that it's going to break out. We obviously don't know which way it's going to break out, but our indication would be that for how long this consolidated in this pennant pattern, when price breaks down or if it breaks up, that would be our indication that there is going to be some continuation of this move due to the amount of time that it's consolidated here in this pattern. Saucers or cup and handle patterns are longer-term reversal patterns where a gradual shift in the trend direction is happening. Usually you can also find a head and shoulders at the bottom and top of such a saucer pattern, but in contrast to the head and shoulders, the transition happens much slower. The transition from lower lows and lower highs to higher highs and higher lows is obvious in such a pattern, and the saucer pattern can often foreshadow a longer lasting trend reversal. So here on the hourly, we can see price came up to here, the 44.93 level, retraced back down, came back up again to retest it as resistance, retraced, and this is our handle pattern of this formation, and then price eventually broke out with a strong candle up, short retest, and then the trend continued. Another tool that can be used on this is Fibonacci from this move to this move, and the handle pattern retraced to about 61.8 of this move. Triangles are a form of consolidation or range pattern where markets just drift sideways for an extended period of time. Triangles can come in many different forms and shapes. In contrast to other patterns, triangles, especially the symmetrical ones, are neutral, and they are neither trend continuation or reversal patterns. So here on a triangle, we can see that this one is generally symmetrical, and that would indicate that it is not an indication of a trend continuation or reversal, unlike the pennant pattern we have here. After a period of trending down, we form a pennant, and that trend continues. So a triangle should be traded with a little bit more maybe hesitation of where it's actually going to break out. And in this one, we can see that if we extend this line, this really came back to retest the top part of that triangle and dipped below that and then eventually went up. But again, the triangles should be traded with a neutral bias and really getting confirmation of where that breakout's going to occur. Flags are a classic trend continuation pattern, and they can often be found on the intraday timeframes. Day traders often rely on flags as tradable events. Flags look like small rectangles, usually tilted against the main trend and mounted on what appears like a flagpole. The main thing is that flags tend to go against the prevailing trend, so a bearish flag is often tilted upward, while a bullish flag is often tilted downward. This was our head and shoulders pattern example. We can see here that when price came back down after the head formation, it formed and respected the support level at 43.71, and it started to trade up in this channel, which was forming a bearish flag. Price traded up into this breakdown level of the head area and then came back down to the bottom of this channel and eventually broke out. The reason that I like flags is because it provides a number of different trading opportunities. You can trade, for instance, if we were anticipating a head and shoulders formation, we could trade this channel up into the breakdown level, and then we could fade this and potentially short this level for an expectation that it will break and validate this bearish flag. Coined by the famed futures trader Joe Ross, the Ross hook may not be the most well-known chart pattern, but it is one of the most frequent and reliable patterns that day traders and swing traders can use to exploit short-term market opportunities. Ross hooks are simply pullbacks that occur after having made a breakout for the upside or the downside, continuing the current trend. So to trade the Ross hook pattern, we need the following several steps. We need to find a 1, 2, 3 pattern, which we have here, 1, 2, 3. We're going to wait for violation candlestick to emerge. It is considered to happen after the breakout of point 2 on the 1, 2, 3 pattern. So here we have the breakout of point 2, and then we want to open a trade after the point 2 retest. So we can see here that price violated point 2, it came down and consolidated, retested it, and then we have the breakout of this small consolidation period. When it comes to rectangles or trading ranges, not all rectangles are perfectly clean with support and resistance levels lining up perfectly, but in most cases, rectangles are easy to spot. They're essentially trading ranges from which price will eventually break out in either direction, hence they provide traders the opportunity to play either side of the market. Here on the 5-minute, we have a trading range that formed overnight, and we can see that it came down here to the lows, the highs, and then respected that low, and then eventually broke out. Again, this is something that you would need to trade in real time to determine what's the most probable breakout area when it's going to occur, whether it's to the upside or the downside. Channels are striking due to their near symmetrical progression. However, although they're easy to identify in retrospect, they're hard to forecast. But if you do identify a market that appears to be channeling, you can use many different approaches to trading a channel, from going long and short to adding successive positions to using it as a measure for entries and exits. So here on the 5-minute, there was an interesting trade that occurred, and essentially we had support form here around the 42 84 level. Price broke down from that support and came down here and started forming an upward channel. And the reason that I like channels, as said before, is because it does provide many trading opportunities, and it provides a clear target when the channel is formed and you have these upper and lower bounds. But the really good thing about this setup was that if you were going long in this channel, the overall target would have been 84 as a retest of this breakdown. And then if you were anticipating the market to break down further and continue with this trend, you would have known that once it took this target out, any further longs off the bottom of this channel may not have been as probable as the ones that were here before when we didn't take out this target. So again, channels, I really like them. They can provide a lot of trading opportunities, but you also have to take them with the overall scope of the market and taking into these kinds of targets that we mentioned here at the 84 area. So that's all I have for you today on chart patterns. I hope you enjoyed it, and if you have any other questions, please visit us at optimusfutures.com.